We started the recording. So today we are going to try and address these questions which relate to. So question number 3 has already been addressed. Now we'll try to look at some of these questions in 4.1, 4.2, and 4.3. And then 5 is relating to Eurodollar futures. We'll see if we can get to that. So we'll first deal with swaps. But I won't use the complicated the classification that I have used in my note. So I've removed that note from your folder. You won't have to study that. We'll study the swaps from your Hull textbook, and also from this book which I've written. I actually wrote this book in 1993, but it is still very much relevant because none of the products have changed. So you can actually, it's quite useful to, because there is no such comprehensive taxonomy of products on interest rate risk management, and in most textbooks you won't find this kind of comprehensive taxonomy. So it's very useful to look at this page and get an understanding of all the products that exist. Okay, maybe we can increase it further a little bit. How does it look? Yeah, maybe we can increase the zoom a little bit. Maybe we can make it 35. That's too big actually. Yeah, 28 is the right one actually. Okay, so let's first look at the question first. What kind of problem is used? What kind of problem is solved by using swaps? All right, and so just to locate ourselves, let's look at our familiar spreadsheet of asset classes, markets, and instruments. And we'll see where we locate swaps. All right, so where are swaps? So today we'll be talking. So we're talking about this instrument now. All right, and so this instrument, as I can just to tell you as a preliminary statement, this instrument now obviously can be applied. It is a asset class instrument combination, this matrix format. So you can apply this to pretty much any of the asset classes. This is most common actually. Swaps is most common in this asset class, currencies, and in interest rates. We make this a little bit smaller. Hopefully we can see everything. We can see all the asset classes, still can't see everything. So let's make it 85. Still can't see everything. All right. Now you can barely see some stuff. Okay. But I don't know if you can read it. But anyway. So now you can see everything. Okay. So these are your asset classes and instruments. So what we are talking about now is, so we've spent some time, you have some understanding of spot, you have traded spot, you are already practicing with futures, although we haven't been able to start the project. I still haven't heard from the broker yet about Ketan and Vipul's accounts. We need to give them new accounts before we start the project. So we just hold on. It'll be a very short project, but there's not much we can do about it. We'll still try to get the basic idea from the project so that we have some kind of theoretical learning at least. So you're doing futures, you have some understanding of futures. We haven't really dealt so much with forwards, but I've told you what forwards are. Very similar to futures, economically very similar, but the forwards do not have the daily cash flows that you see with futures, because every day's P&L is going to be either paid to you or taken from you, whether it's depending on whether it's a profit for you or a loss for you. Whereas in forwards, there's no such cash flow. You have only one cash flow on the settlement date, whatever that is. It could be 3 months, it could be 6 months, it could be 12 months. Sometimes in FX, you can even get 5 years, 10 years forward, FX forwards. A fairly liquid market actually, at least up to 5 years. So therefore, there's only one cash flow on the settlement date. Otherwise, these two are fairly similar, futures and forwards. And of course, the other difference is this is an OTC product, and this is a futures. This is an exchange traded product. Now we're doing, and you've also done options, right? So now we're doing this new instrument called swaps, which we haven't really had time to cover. So swaps, as I said, mainly will feature, swaps are mainly used, most of the liquid activity in swaps, most of the activity in swaps is in this asset class currencies and in this asset class, debt or interest rates, okay? Sometimes erroneously referred to as fixed income, which is not really correct because, but this is how people talk in industry. You'll even see that these big investment banks, when they report earnings, if you guys have been following earnings releases, you should be. Yes, Shaurya?
Nothing, sir. It raised its hands by mistake. Sorry, sir.
No problem, no problem. Okay, so fixed income is the term that people use. If you notice, if you follow the investment bank earnings releases, which you should, and get into the earnings calls, you'll see that they have a category called FICC, which I might have discussed with you. Have I discussed FICC with you? Yes, anybody? Have I discussed this term with you, FICC? I see.
No, sir.
No? Okay, so you should know this.
No, sir.
Yes? No, we haven't, right?
Lastly,
No, sir, we have not.
Okay, all right. Okay,
आज second last है.
okay, somebody's not on, so just take
19th है आज.
Bhavya was not on mute actually. Okay. So let's look at this. This is 5-2. Today is 9-2. Okay, let's talk about this. This is an important thing because you're going into industry. You guys have to step up the level of effort because you should have been listening to all kinds of earnings calls. If you're interested in, in industry jobs, you want to get the jobs as equity analysts, you should have been listening to earnings calls. At least target a few companies. I've told you guys to target a few companies, and you should be listening to earnings calls. And all those are available as recordings. You should have done that, even if you don't do it live. So if you don't get fully involved, it'll be very hard to get a job of the type that you like, because you have a little bit of a disadvantage because you're not going from IIM Ahmedabad. So you need to put in extra effort to be able to compete against students from these higher ranked business schools. So therefore you have to put it, but I'm not seeing enough. There is effort definitely going on with a lot of students. There's good effort, but you need to step it up even more. Okay. So FIC is basically FICC. You will see this when they report earnings. There's a very peculiar way that most investment banks and commercial banks with big treasury operations, they organize their things. What they do is they organize their currency operations. So FICC is fixed income. This is what is used to refer to the word debt, to the asset class that is better referred to as debt. Or interest rate sensitive assets. These are more correct terms, so I've used them, but the industry does not bother with all this theoretical elegance. So they just use whatever comes to mind. And so fixed income, and that's what they use to refer to this asset class. So FICC is actually fixed income, currencies, and commodities. So they have a peculiar way of organizing and reporting their income, which is our activities, this is kept separate, equities is kept separate, and these three are reported together. So it's very strange, actually. It doesn't make any sense. But very for historical reasons, because the licensing of the subsidiary is slightly different and all that. So maybe because of that reason, so we organize them differently. All right. So this is what is it's a term that you need to be aware of. That's all that it means. Okay. FICC is fixed income, currencies, and commodities. Okay. It's a way of reporting income. So just check this. I'll save some time and I won't elaborate on this. You can Google this, but I'm just telling you what it is. Fixed income, currencies, commodities is a way of reporting their income and organizing their businesses, which according to me is not very optimal because there is no real substantive difference. These are all markets. So it should be all part of one markets division, not a part of the separate FICC kind of reporting. So unless there's a regulatory reason for doing this, this is not actually optimal. So anyway, so swaps is here, okay? So it's a type of instrument. And then, as I said, most of the activity when you look at swaps is here. So I've given you one example, which is IRS, interest rate swaps, all right? And Okay, interest rate swaps, and there's IRS, there's interest rate swaps, and just one example. There are the other kinds of swaps which happen at the intersection of debt and swaps. And then you have the intersection of currencies and swaps, but you can also get swaps in these areas. Okay, so let's first look at the structure of a swap. So what I will do is let me just see here. Give me a second. Okay, so let's look at, so before we get to the definition of a swap, let's just look at some examples of swaps. We are going to, I will create a separate node for you. Okay, so I'll put this first into the session notes here. So the question is, let's look at this question here. The three questions that relate to swaps. At this time we are discussing, here we are discussing the swaps with respect to interest rate and currency risk management. So, so I would also, we can also refer to this classification here. Maybe we have to get down to 25. We can't see everything.
So we can't hear you.
Sir, you are on mute.
Okay, sorry. Yeah, good point. Good point. Because I was it had that disturbing noise, I muted myself. All right. So here, interest rate and exchange rate management was being discussed in this book, but there is a recognition that these two asset classes also exist, major asset classes. So they were mentioned just to show that we are aware of that. Okay. So there's a little bit of a discussion here of risk. Okay. And you can see mainly, we're interested in this one actually, this one here. It's quite small here. We may want to increase the font size here a little bit, and maybe even bigger than this. We can refer to this page. Yeah, I think this will be useful. So we are going to be referring to this classification. Look at all this this discussion. First, let's look at the questions in the case. Okay, so we're talking about how the swaps, what kind of problems could be solved using swaps. So here you see the problem. What is happening is that the Aussie dollar loan has a 5% interest rate. It's a fixed interest rate. And the CEO is looking at low short-term interest rates on the Aussie, right? And therefore, what he's thinking about is, let's look at the sovereign yield curve. It'll give you an idea. So this is known as a yield curve. I don't think I had time to cover this with you, but it is covered, and yield curve is covered. Everybody should cover these notes on their own, okay? And then if you have questions, you have to ask me. Then we can get, sorry, I clicked the wrong sheet. Here, this is very important for any student of finance. Now, I have not highlighted cross-sectional data charts because it was not important for your project, but right now it is. Okay, at that time it was not highlighted. So you have to anyway read all of this stuff. And so cross-sectional data charts, if you read these, so all these three should be understood by everyone, because if you if you don't understand these three notes, it'll be very difficult for you to follow any advanced discussion in finance. Okay, this is the basic discussion of all kinds of charts that are used in finance. So the yield curve that is talked about here, this is an example of a cross-sectional data chart. A cross-sectional data chart is very simple. It's have they changed the format here? Yeah, no, they've got the yield curve still. Okay, so this is a yield curve. Okay, So they've given some discussions here. All right. So here, just look at this. This is an example of a yield curve. This is nothing but you guys are already familiar with the yield curve. If you look at if you look at HDFC Bank fixed deposit rates, that's an example of a yield curve. Okay, so and you've already been introduced to this idea, which is you've seen it in the implied volatilities when you looked at implied volatilities for Tesla options in your option trading. That was also an example of a cross-sectional data chart. All right, so that cross-sectional data chart is nothing but a snapshot at a point of time. If you read the notes, you'll see the definitions. It is basically one point of time and at least two markets. One market, at least two different, at one point of time, and a snapshot of at least two different variables. Okay, so in this case, the variables are the 2-year rate, the 4-year rate, 6-year rate, 8-year rate, 10-year. These are all so many variables. But you can actually have a cross-sectional data chart if you have two of these. That's all you need for a cross-sectional data chart. Right. So if you another example of a cross-sectional data chart would be if I take everybody's temperature in the class. So if I take that's an example, and I plot the temperature that it was taken today at 11:15, everybody's temperature. Then that's an example of cross-sectional data because it's a point of time, and it's got at least two variables, which is any two students' temperature. So that's the nature of a cross-sectional data chart. So yield curve is this. So what this guy is saying is that what the treasurer is saying, what the CEO is saying here is, why am I paying 5%? Because this is a sovereign yield curve. It's not really what a corporation would pay. You pay a little bit higher. But what this guy is saying is, why am I paying 5%? This loan must have been taken many years ago. So he's saying, why am I paying 5% and how many years does it have? 10-year maturity, okay? So this guy is looking at the 10-year point on the Aussie curve, and he's looking at, see what is Aussie 10-year? Aussie 10-year sovereigns are 1.23, okay? 1.23%. And which means a corporate will probably pay whatever. I mean, depending on the credit rating of the corporate, probably will pay maximum 200-300 basis points above this. So probably around 3.5 or whatever, if it's not even a good quality corporate. If it's a good quality corporate, maybe it will be able to borrow at 2.5 or even below 2. So now what happens is, so this guy looks at the rates and he's saying that look at this, and he's especially saying that look at the short-term rates, which are very short. I mean, very, very low, 0.03% if I look at 1 year. So he's saying, why don't I swap into LIBOR, which is at the short end of the curve? And he's saying that he wants to swap this into a floating rate. So even a 1-year LIBOR would be a floating rate. So he's saying that why don't I swap this rate into, instead of paying 5%, why don't I pay at a 1-year resetting frequency? Let me pay against 1-year LIBOR, and that'll lower my interest cost. Okay, so there's a kind of instrument that you can use, which is called a swap. Which is what you would use to achieve what the CEO wants. This is the first example. So it's just giving you a flavor of the kind of problems that are used that are solved by using swaps. So let's see what we have here. Okay, so here you can see once again, you can see lots of different interest rate charts. And this is the cash rate target here. This is the Australian policy rate. Okay, this is the RBA's Australian policy. This is taken from the RBA website. So as I've told you, if you want to do random research on the web, you can go to the central bank websites. They are very good. You will not get garbage information there. Some of the economic theory may be questionable, but then pretty much all economic theory is questionable. But at least you will not get wrong information. Okay, and it's a useful thing to do to look at all the central bank websites. So here you can see. So this is the Aussie. This is the Aussie equivalent of India's repo rate. So India repo rate, and this is the Australian cash. This is Australian central bank policy rate, and you can see they have cut it. And they cut it after the global financial crisis dramatically. And then they cut it in again. So initially, Australia was one of the few countries that retained some high levels of rates. And now they've cut it all the way to zero, slowly. Okay, and this, with COVID and all, I don't think it's coming up anytime soon. So you have all this. So this is just for your review. You can check these things out. You can close this now. We'll keep the yield curve because it's going to be useful. So that's the first kind of problem. The same kind of problem actually, the CEO is again was looking at the same kind of problem actually here. The yen loan has an 8-year maturity and a fixed interest rate of 2.75. And the question here is, should they swap it into a floating rate? Okay, because this rate is quite high. Should they swap this into a floating rate? So it's a similar kind of question. And so because here we are asking you, what advice would you give the CEO? Because the CEO wants to change from 5% to a floating rate. Okay, so we'll see how that works through swaps. And the third example is here with the case of the Aussie loan. We're talking about which swap structure can be used to simultaneously hedge the currency risk on both the principal and interest payments on this Aussie loan. Okay, so it's actually the question should be which can be used to solve both the currency. Yeah, there is no interest rate risk on this loan, but if you use this structure, there would that statement would remain true that there would not be any interest rates on the new structure as well. All right, so it will remain as a fixed rate loan. Remember, this is already a fixed rate loan, so there is no interest rate risk on this loan because it's fixed at 5%. There's no uncertainty, there's no variability, and he's now talking about swapping it into a floating rate, which will introduce some variability. So these are the all right. Here the answers actually also given here about as to this particular structure. Okay, what is that particular structure? So we'll see those structures. So these are the kind of problems in the context of which we start discussing swaps as an instrument. Okay. So generally we use swaps for two kinds of. 1 minute. Just give me a second, okay? I'll just. So let me see the Halbasu chapter 7 also, and that's also something that we can refer to. Yeah, so Halbasu chapter 7 is for swaps. So this also you should read, okay? This is part of your readings. So read this. So what I will do is I will just put this note here, then I'll create a separate note for you guys, okay? I'll put this into the session notes, and so what I'm putting into the session notes is, let me put this here. I think we don't need this at this point. Move this here. Yeah, so we're talking about swaps now. Later on, I'll put this whole thing into a separate note. So the entire discussion of swaps. Okay. Yeah. So here is given you the readings here. You can look at. Right. So you can also refer to the RMS refers to this book. The Risk Management Solutions book. Okay, so this is what RMS is referring to, Risk Management Solutions. All right, let's look at this. So essentially the word swaps is used in two contexts, and we have to be familiar with the industry nomenclature. So either people say swaps or they say FX swaps, okay, or foreign exchange swaps. So FX can be also referred to as foreign exchange swaps. So FX is short for foreign exchange, these two terms, okay? So you have to use the term carefully because these two structures are quite different, okay? So it may seem like, okay, they're the same thing, but just a couple of words make a difference. So you have to be very particular about what you are referring to. So if you're referring to the swap structures, which we will discuss just now, or you're referring to FX swaps, you have to be very careful. So you have to, mention what you're referring. You have to clarify what you're referring to in your discussion. Yes, Srishti?
Sir, I was saying that is there any other cost which is connected to these swaps which makes it costlier than other instruments? Because this way everyone will swap with the lower interest rate instrument and escape from paying higher amount.
Yeah, so you'll see the answer to that question. Just wait and see. By the time we complete the discussion, you will get the answer to your question. Okay. Just wait.
Okay, sir.
Just wait for a while. By the time we finish the discussion, you will get the answer to the question. Once we finish answering, first what we are going to do initially is we are going to understand the structures of the products, because as you can see straight away, there are two different ways in which industry uses the word swaps, and they are quite different from each other. The two instruments are quite different from each other. So you have to be very careful about the terminology. And we are just learning right now at this point, we are learning about the terminology and the different kind of product structures. And then later on, we'll come into the discussion of, we will return to the questions in the case and we will address those questions, and then it'll become clear to you. The questions that you're asking now, that will become clear to you. Okay, just wait for a while. So there will be, obviously, everything you do will have some kind of consequences. So you have to look at what are the consequences of what you're doing. Right, so just wait one second. Try to at least find something here. Okay, so this is the first thing that we are aware of. Swaps are used in two ways, swaps or FX swaps. Okay, so we are talking, when we say swaps, we are referring to a few structures, which is these structures: interest rate swaps, currency swaps, and there are also examples. These are similar structures, actually quite similar basic structure. We can have these swap structures either as interest rate swaps, currency swaps. Now, remember one thing, that a currency swap is not the same thing as a foreign exchange swap. Now, this is why I say once again that finance is not really a mathematical subject, because there are so many differences in the meanings of words depending on the context in which they're being used. So it's much more like law than it is like physics, because in physics you would not have these kind of situations where a currency swap is not the same as a foreign exchange swap. Because what we have learned in general, that is that, as you can see here in my framework here, instead of referring to foreign exchange as an asset class, I have referred to currencies, because here what I'm doing is I'm using currencies as a synonym for foreign exchange. Okay, so instead of saying foreign exchange markets, if I say global currency markets, I can refer to global foreign exchange markets by saying global currency markets. So currencies and foreign exchange are being used interchangeably. However, when you come to the discussion of swaps, suddenly you have a problem, because you can't use currency and foreign exchange interchangeably, because a currency swap is not a foreign exchange swap. Okay, so this we should write here just to be. NB is nota bene, which is watch out. Okay. A currency swap is not an, you have to be aware of this, okay? So this is a very strange thing, because normally we can use currencies to replace the word foreign exchange. But when we are discussing swap, when we're in the context of swaps, a currency swap is not an FX swap. So you have to be careful about that. And that's why, as I said, finance is much more like law, a very context-dependent subject, than it is like physics or mathematics. Okay, so these are the first two categories that we have to look at. And then when we talk about swaps, we'll first discuss swaps. Our main concern here is with swaps today, because the questions in the case don't relate to FX swaps. They relate to these swaps, okay? So these are basically, you have currency interest rate swaps, and currency swaps are the main, this is where the main activity is. And then you also have equity swaps and commodity swaps. You can have them, but the structure will be the same as these two, right? So let's look at the structure of these kind of instruments, okay? let's look at, so let's start to study the structure of a swap. And for that, we can look at, so these are all the various types of swaps that you can have on interest rate and currency swaps. But let's look at the basic structure from here, okay? Maybe we should make this 110. So let's look at the basics. You guys should read all this stuff, of course, okay? Yeah, so here's the basic structure of a swap, okay? What they're doing is, you can look at this, let's see, there's a discussion here. Okay, so yeah, this is good because it tells you there's all the structure that is explained as well, and you can see the picture at the bottom. So what is going to happen here, look at this 3-year swap between Apple and Citigroup, okay? So notice one thing, that the swap has a certain maturity or the tenor of a swap. This is referred to the tenor of a swap, okay? So it's a 3-year swap, okay? And of course, there is a transaction date, and there are 2 counterparties, okay? So we can note these things, okay? We can note these here as we are studying them, okay? So what are the features of a swap, okay? So we can see counterparties. Obviously, in any transaction, there's counterparties. Then there is a tenor, tenor or maturity. In this case, there is a maturity is basically the end of the transaction, okay? So here, that tenor or maturity in this example is 3 years, okay? We can see that. And then there's, of course, a transaction date, right? All right. And let's see something else we can see here. Okay, what do they say? Let's look at the terms. So let's remember this thing, that this is just a contract. And the reason it is listed separately, why are these all listed as separate instruments? Because instruments are just types of contracts. So maybe we can do a little bit better now and give you a little bit more visibility. And maybe we can have it even 1994, 85. Okay. So why are these different contracts? Because these are different instruments, because these are all different types of contracts. So if you enter into a contract as a lease contract versus a leave and license contract in real estate, there's slightly different sets of rights and responsibilities. So therefore, these are different contracts. So these are all different contracts, and that means that they have different types of contractual obligations. All right. Options, as you know, is a different kind of contract from swaps, from futures, forwards. So swaps is a type of contract. So let's look at some of the contractual obligations that exist in the case of swap. So you have a transaction date. Now let's look at some of the contractual obligations. What do they say? Now notice it's a 3-year swap, okay? And now it has a notional principal, okay? Let me see if I can we are not interested in the example. This is just an example, okay? It has a notional principal. We want to have this looking a little bit better. So we want this to, yeah. So this is called a notional principle. Why is it a notional principle? You understand the meaning of notional? Notional comes from the word notion, which means an idea. And therefore, when we say it's notional, which means that it's not real, okay? We're just creating the concept of it, but it's not really something tangible, okay? So that's why we say it's related to an idea. It's notional. It's a notional principle. We don't use the word principle. So in this case, yeah, so I'll come back to this. We have to ignore whatever background noise is there. Notional principle. So here's an example of notional principal of this loan. Why is it notional principal? Because when we normally take a loan, there is a principal amount. If I take a loan from the bank, okay, then if I take a $10 million loan as a company from a bank, I have to pay back the principal, and then I'll refer to the principal as $10 million, which is the amount that was disbursed to me. And then I have to pay P plus I as well, which is the interest. So there we don't say notional principal because there's actually a principal which was given to me as a loan principal. So there we don't say notional principal because there's an actual principal. Here, there's actually no loan as such that is going on between these two counterparties. Okay, so that's why we say notional principal. So there, whatever be the amount. In this case, it's 100 million. It could be anything else. Okay. Now, and notice one thing here, that because it's a type of contract, it's a type of contract as opposed to an option contract or a futures contract. And so it has its own peculiar kind of terms. Every contract has its peculiar kind of terms. So what are the terms of the contract? Look at this. Apple agrees to pay 3% per annum on a notional principal and agrees to pay here. This is a 3%. Notice that this is a fixed rate. So Apple will pay a fixed rate. And what is Citigroup paying? 6-month LIBOR. Okay. So 6-month LIBOR, remember that in this note, in the diagram, they have not mentioned 6-month LIBOR. They have not shown 6-month LIBOR, but it's actually 6-month LIBOR, as you can see in the example. Okay. 6-month LIBOR means that the rate, as you can see from our previous discussion on here. Yeah. This discussion is with respect to, say, a 3-month LIBOR. That 6-month LIBOR obviously is going to mean that you just imagine that this is 6 months. So that the actual amount to be paid by Citigroup, now who Citigroup is? Citigroup is paying, agreeing to pay 6-month LIBOR rate on the notional principal. Okay. So this 6-month LIBOR rate, the problem is going to be for Citibank is that they would not know the rate because remember this is a 3-year loan. Okay, this is a 3-year swap. Okay. So if you take 6 months, that'd be a total of 6 periods, okay, for Citigroup. Because 6-month LIBOR into 3 years divided by 0.5, so that's a total of 6 periods. So 6 such periods, different colors, different periods, and Citigroup knows the actual interest rate to be paid, the actual figure, only for the first period. The balance 5 periods, they don't know what it is because it will depend on what happens to the 6-month LIBOR rate between today and the next 6 months. Okay, and as you saw from the chart that I showed you, the LIBOR chart, that can fluctuate quite rapidly. So there is a certain element of uncertainty in that. All right. So here you already see the answer to part of the answer to Srishti's question. That if you swap into floating and take an advantage, you can already see that there is some risk associated with that, which is because then you're now moving to a variability because you don't have visibility beyond the first rate setting period, right? So, so this is what the terms of the contract say, that Apple will pay 3%. So here 3% for Apple will not change over the 3-year period, all right? It'll be the same. This will be 3%. And then Citigroup will pay 6-month LIBOR, which means they will have to, every 6 months, they'll have to figure out, okay, what was the rate setting of LIBOR today? And then I will pay that rate for the next 6 months, all right? So for instance, it's the same thing. If you see it from the investor side, it's the same thing if, for instance, somebody has, let's say that Aman has a lot of money. Now Aman wants to invest money. Now he has a choice. He can straight away put that on a, if you imagine that these are, HDFC Bank fixed deposit rates. Now he can straight away put it on a 10-year deposit, okay, or 9-year deposit, and just forget about it. Or what he can, that's one option. And then what the other option is that he's going to say that, no, I think, why should I just lock into 1% for 9 years? Let me wait because I think interest rates are going to go up. So let me just put it only on deposit for 6 months. And after 6 months, I think interest rates will be a little bit higher and then it'll keep on rising, okay? So the other option that he has is either you put it on deposit straight away for 9 years, or you keep on doing a 6-month rolling deposit. So you put it on deposit for 6 months, and you think rates are going to be higher. So next 6 months, after 6 months, the next interest rate for the next 6-month block will be higher for you, and so on and so forth. Every time it's going to be higher for you. So that's another alternative. Okay. So it's the same thing. that you can either put it on deposit for a long period, or you can fix the rate for a long period. Whereas you can also do the other option, which is you keep on investing for short periods. So you do a rolling 6-month deposit over 9 years. So that's a total of 18 deposits. Now, this is basically, you can see this also in the two parties. It's as if Citigroup is doing that first option for Aman, which is they are investing. Well, of course, they're paying here, but I'm just talking about, let's forget about the paying, receiving part. But they're choosing a fixed rate over the full tenor, which is 3 years, whereas Citibank is choosing the same tenor, but instead of choosing a fixed rate, they're choosing a rolling set of short-term periods, okay, to come to the end of the full period. So this is basically the contrast here. So you can see this contrast even from the investor side. But this is basically what's happening. So the other thing that we notice about swaps as we try to study the structure is that everything has contract terms. Usually contract terms have different obligations. The obligation is the same. If I'm going to give you a cup of coffee and you're going to give me a cup of coffee in return, then there's no incentive to do the contract because I already have the cup of coffee. So usually the fact that two parties are entering into a contract means that I'm going to give you X and you're going to give me Y, which is different from X. All right. So this is also something which is common to commercial contracts, which is contract terms. There will be some contract terms, so watch out for those contract terms and read them very carefully, including all the stuff you see, which are called, terms, contracts of adhesion, where you go in for these software contracts, where they give you a standard contract, and you have to, when you install your apps, you have to accept the terms, otherwise you don't get to use the software. So those are called contracts of adhesion. Those are all contract terms. And then you have contract terms with different obligations. Okay, both parties have different obligations. That's another thing. And now you can see what are those obligations. Citibank's obligations to pay 3%, and Apple. And Citi will pay 6-month LIBOR. Okay, so this is what happens. Now we call these are the terms, fixed rate payer. So in the swaps market, the terminology in the swaps market is everything is with reference to the fixed rate. Okay. So in this case, you can say we can write some of this material here, just to give you a sense of this will not be there in the textbook because this guy he has not operated in the market. So, but it will be there in this book. Here you mentioned, this is all mentioned in this book, because it is written for people to participate in the market, corporate treasurers who participate in the market. It's already there, but I'm still writing it. Fixed rate payer. The fixed rate payer is just called the payer. In the swaps market, if I say that I'm paying on a 10-year IRS, if I say I'm paying on a 10-year IRS in a swaps market, IRS is interest rate swap. If I say that, it is automatically understood that I'm paying the fixed rate on a 10-year IRS. So in this case, what Citigroup would do, Apple would refer to this transaction as we just paid on a 3-year swap with Citi. Citigroup will say we just received on a 10-year swap on a 3-year swap with Apple. Okay, so we should write this. I think it's there in my book, I'm pretty sure, but I'll just write it anyway. Fixed rate payer is equal to payer receiver. Let's call this payer receiver, because there are some terms later on you'll see if you go to this book. So I have explained this because if you see here, there are some terms later on which are hesitant to click anywhere here. Yeah, because it may actually put that colored. See, when I look at interest rate options, which is covered under non-standard solutions, yeah, Non-standard. So this book is structured this way. There is a high-level division into interest rate risk management and currency risk management. Exchange rate, okay, currency. And within each of those sections, there's a sub-classification into standard solutions, which are essentially your linear payoff profile solutions. And the non-standard solutions are the option-based solutions. So you see this classification. This is how I structured the book. All right, so you can look at that. These are linear payoff profiles, and these are the non-standard solutions are the option-based non-linear payoff profiles. So here, when you look at interest rate option structures, interest rate risk management option structures, you will see that there are swaptions. Swaptions are basically options on swaps. As I told you, options have many types of underlyings, and in fact, for options, because they're a derivative market, they will have some underlying market instrument combination, and the instrument part of that combination could be swaps, could be forwards, could be futures, could be spot, could also be an option. And it's a compound option, that it's an option on an option. So you have to be conscious of, in the case of compound options, you have to be conscious of which option is the underlying and which option is the actual derivative contract. So swaptions are here, listed here. You notice swaptions are listed at the intersection of options and debt. Okay, so these are actually options on interest rate products, on interest rate swaps. So therefore, these are listed here at this intersection. And so you can see here. And now you see this terminology: payer swaptions and receiver swaptions. This is a terminology that is used in the market. Which is here, what is the meaning of payer? Payer means fixed rate payer. Receiver means fixed rate receiver. This is what I mean by this statement, that in the swaps market, fixed rate, so in the market jargon, okay, the fixed rate payer receiver is just referred to as payer receiver, which means essentially by default we are referring to the fixed rate. So in this transaction that we have, here, we go back to the Apple and Citigroup transaction. In this transaction, Apple is paying 3%. So Apple will refer to this transaction by saying, we just paid on a 3-year swap with Citi. And Citi will refer to this transaction as saying, we just received on a 3-year transaction with Apple. That's the meaning of this, okay? But people don't bother to mention, I received the fixed rate or I paid the fixed rate. An automatic reference to the fixed rate. And here, of course, here they're taking the floating rate pair. It's a different kind of way of looking at it. That Citi is playing the floating rate, okay? So here, obviously, so what will happen here? Let's look at the contractual obligations now. How the structure works. Now we are focusing on the contract terms with different obligations. All right. How does it work? That's where you see the diagram. We can maybe come down a little bit. I don't know if it goes down smoothly. It just seems to jump onto the next page. Yeah, you can still see it. I don't want to go down further. It might just jump to the next page. Or we can actually make this a little bit smaller. Yeah, now you can see this more clearly. Okay, so you can see this. Now this is how it works. Now let's look at the contractual obligations. So what will happen is payments are to be exchanged every 6 months in this transaction, okay? This is where we're looking at the nature of the contractual obligations. So this means that every 6 months, we'll have an exchange of payments. So we will look at what is the 6 month, what was the 6 month LIBOR fixing 6 months ago? Because this LIBOR applies when it has to be paid at the end of 6 months. So if you look at the first transaction, if you go here, so we start here, this is actually 3 months, but let's talk about 6 months. Okay, so which means we just ignore the 3 month point. We go straight from here to 6 month point. This should be actually centered, and it'll make more sense, right? And we can actually put it like this. Now you can see the blocks more clearly. It's a 6 month block, so we ignore the 3 month block. So we start from day one. This is a transaction date. Okay, we have the transaction date, which is March 8th. 2017. Okay, so this in our transaction, in our example, this is March 8, 2017, the transaction date. So the first exchange of payments is going to happen after 6 months here, 6 months later. So this is September. Okay. Now, what will be the payments? So there'll be a first exchange of payments, as you can see here, like this. Okay, this is why it's called a swap. A swap basically means an exchange. Okay, so so we could say, let's swap our smartphones, which means you give me your smartphone and I'll give you my smartphone. So we swap our smartphones. So that's where the term comes from. Okay, swap. This is a swap where it's an interest rate swap because one party is paying a fixed interest rate, and one party is paying a floating interest rate. So we are swapping fixed and floating interest rates. Okay, that's why it's called an interest rate swap, and it's actually called a fixed for floating interest rate swap. So we'll come to that term. But what we are noticing here is how do the contractual obligations get paid? How are they actually sort of discharged? Okay, to use the terminology of contract law, you have contractual obligations under a contract. And then when you fulfill the obligations, we say that your obligations are discharged. Please remember all these terms because as a business student, as an MBA, you have to use the technically correct language. You can't talk like a layman because now you've done an MBA, so people expect you to talk in technical terms. So, and that applies even to legal terms. So this is how the contractual obligations will be discharged. Every 6 months, there will be a payment like this. So Apple will pay 3% and Citigroup will pay the 6-month LIBOR. Which 6-month LIBOR? The 6-month, so the payment is happening here, but Citigroup's, what is Citigroup having to pay? Citigroup has to pay the LIBOR, okay? So what interest rate will Citigroup pay here on this date in September? That has already been determined in March. Okay, so when they started the transaction in March, they would have noted what was the 6-month LIBOR rate setting for that day, right? Whatever it is, maybe it's 5% or something like that. Okay, so if we take 5%, then they would have made a note of that payment, and they would have of that interest rate, and they would have recorded that okay, that this is the 5% is the amount because it's a 6-month LIBOR setting today. This is the amount that Citigroup has to pay under the swap 6 months later. Just like when Aman is investing in a 6-month fixed deposit with HDFC, he does not get his interest payment upfront. He will get it at the end of the period, but he knows the interest rates on day one. On the transaction date, he knows what the rate is. Maybe it's 3.75%. But he knows the rate on, for the 6-month deposit on day one, but he doesn't get that return until the end of the period. All right. So therefore, this is the same structure that Citigroup will know what they have to pay because the rate has already been set today. But of course, they don't know what the rate setting will be 6 months later, which they'll have to pay after 12 months. This is how the structure works. And then what happens? Okay. So what we call this is contract terms. Okay, let's look at the contract terms in the case of the Citigroup example from Halbasu, page one, we refer to as 155. Okay. Or we'll refer to as the section header, which is the best way to do it. I think it's going to be 7.1. Yeah, 7.1. So this is our jargon. Okay, so we'll call this jargon. Right. So yeah. Here, so let's look at the contract terms with different obligations under that. Let's look at. Oh no, we can just take it under jargon itself. Okay, we'll take it as jargon itself. That's one. And let me say floating rate, example LIBOR. Okay, we say this is actually set in advance and paid in what we call arrears. Okay, so the term that we use is set in advance and paid in arrears, okay, which is a fancy term for what you already know happens, that when you have any kind of interest payment, that it is always set in advance and paid in arrears. Okay, so you see the interest rate for the period in advance, but you don't get that return until the end of the period. Okay, so it's a fancy term for that. But these terms are important because there are later on, as you will see here, there is a structure which I've talked about here, which is called a LIBOR and arrears swap. If you see under standard solutions, there is something called a LIBOR and arrears swap, which you will find, I'm sure, here. It should be here. Interest rate, basis swaps, so amortizing, swaps, step up, step down, callable, puttable. Okay, for some reason I don't seem to have discussed. There's actually a failing. It should have been mentioned here under LIBOR and arrears, or have I mentioned it under swap? It's not really an option structure, so it should have been mentioned here. There's a problem here. There's one structure which I've not mentioned, which is the LIBOR and arrears swap, which should have been mentioned. It's a structured kind of product, okay? So that's a different kind of product. So that's why the terminology is important. That in normal LIBOR, okay, it is set in advance and paid in arrears, okay? So if you have LIBOR and arrears, that that will mean that it is set in arrears and paid in arrears. So you get to know the rate only 2 days before. Okay, so there is, I think at this point, we should also mention this point since we are discussing swaps. This is normal floating rate. Normal floating rate setting, okay, if you have a structured product, it will be different. We don't need to worry about it, but we should be aware of it. Structured products. In structured products, you can have something called LIBOR and arrears. We'll just put this here like this. It's just useful to be familiar with this terminology. What are we talking about? Yeah, there's this asterisk is here. Structured products, you have something called LIBOR and arrears. Okay. If we talk about LIBOR and arrears, this will be the kind of expression that is used. Okay. I should have mentioned that. I don't know how I missed that in the thing. But anyway, so this means that this is set in arrears and paid in arrears. So what that means is, this is a very unusual structure actually. So maybe that's why I didn't mention it in the book, because it's also a risky structure. It goes against the idea of hedging because it is more risky for the client. So maybe that's why I didn't mention it. But all right, let's look at it. Okay. So normal floating rate, example LIBOR, will be set in advance and paid in arrears. There's also something called LIBOR in arrears, which is set in arrears and paid in arrears. What that would mean is, in normal LIBOR, you would set it on the day 0, and you would pay it after 6-month LIBOR, set on day 0. Rate is determined on day 0, but the actual interest payment happens 6 months later. In the case of LIBOR and 6-month LIBOR in arrears, what will happen is the payment will be 6 months later, and the rate setting will also be the rate that is 2 business days before 6 months. Okay, so just about here. So you don't get to know the rate at the beginning. You get to know the rate only 2 days before you have to make the payment. Yes, Aman? Yes.
Sir, how will we differentiate between fixed and floating interest rate?
Here, because you will know that a fixed interest rate will also always be referred to like this. You see, when someone tells you that you have to pay 3% for 3 years, you know that's a fixed rate, because 3% is always, all interest rates are mentioned as per annum, on a per annum basis. Okay, so you know that you have to pay 3% for whatever the period of the loan is. Or in this case, there's no loan, there's an interest rate product, the swap structure. But you know that this is a per annum rate, and this is for the tenor of the transaction, 3 years. So you know this is obviously a fixed rate. Now this obviously the floating rates will always be referring to some kind of floating rate benchmark, and the other clue that it's a floating rate is that it will have some kind of term like this, either 3-month LIBOR or 3-month SOFR or overnight. SOFR is actually an overnight rate. Okay, so this some kind of floating rate. Okay, it'll have some kind of a period which is less than equal to 12 months. So LIBOR you can have up to 12 months. There is no concept of 15-month, 18-month LIBOR. Okay, there is no such concept. These are all the floating rates are all either you have 1 month, 3 months, 6 months, 9 months, 12 months, which means if it's 1 month LIBOR, if I give you a loan for 5 years based on 1 month LIBOR, a very unusual structure, but we can do that. That means every 1 month I'm going to change your rate. We'll look at the 1 month rate setting, and that's what we'll have to pay for the next 1 month. Get my point, Aman? Yes?
Yes, sir. Yes, sir. Yes.
Yeah. So the way you know that it's a floating rate is because it'll have some kind of mention of some kind of index, well-known index like LIBOR, or it could be MIBOR, which is Mumbai Interbank Offer Rate. It could be SOFR, okay, which is the overnight rate. So, and the way you detect it is basically you ask yourself this question: this rate, how frequently is it reset? Because in the case of a fixed rate, there is no resetting concept. Once Apple signs this contract, they have to pay 3% for the tenor of the swap. They can't change this. This is locked in. This is a fixed rate. But if you look at the structure of Citigroup's liabilities, it is 6-month LIBOR. Now, this could have been 1 month. It could have been 3 months. 3 months is the most common period. Could have been 9 months. Could have been 12 months. Okay. So there you would ask this question, okay, how frequently is this interest rate going to be reset over the period of the transaction? The period of the transaction is here. And so if you ask this basic question, okay, how frequently is this interest rate going to be reset, okay, over the period of the transaction? That's a fundamental question to ask. In the case of the fixed rate, the answer is, well, it's only set once because 3% is set and they have to pay it over 3 years. In the case of Citigroup, it will be some figure which is more than once. In the case of 6 months, it will be reset. There will be basically there will be 6 resets because 3 years and 6-month LIBOR. Whereas in the case of 3-month LIBOR, there would have been 12 resets. So that would be, so it's a good question actually. How do we determine whether it's whether it's a floating rate or so let's put it under jargon itself. So we can call this Aman jargon since it's based on his question. Okay, so but it's an important question actually. Okay, so the answer is, okay, stick to all caps, it takes too much time. Okay. This is interest rate, okay? The percentage sign is the interest rate. So set, when you reset it, is also being referred to as a set, okay? Resetting is a setting also, okay? So the resetting is captured by looking at the answer to this question. How many times is the interest rate being set or changed or determined, okay, over the tenor of the deal? We'll just call it the deal, okay? The transaction is the deal, okay? So ask how many times the rate of the percentage, the interest rate is being set, changed, or determined over the tenor of the deal. All right. If answer is greater than 1, okay, or once, okay, then it's a floating rate. So there's a mechanical way to determine, if a computer-based a definition for a computer, then it's a floating rate. Else, it's a else it's a fixed rate. Okay, like else it's a fixed rate. Okay, is this clear? Does that answer your question, Aman? Yes, Aman, answered your question. So how will you know whether it's a fixed rate or a floating rate? You apply this test. Yeah, okay, all right, okay. So you in this case, you know that Citibank is paying a fixed rate because Citibank's interest rate is not changing over the yeah, okay, fine, no problem. That's fine. Okay, I got the message. So it's clear now. And so Citibank's interest rate is not changing because when you ask how many times is the interest rate changing over the course of the period transaction, then the answer is only once. Therefore, it's a fixed rate. And in the case of Citigroup, it is changing potentially 6 times, okay, or it is changing 5 times, and there are 6 different rates. There's a first setting, and then we don't call that a change, but it is changing 5 times over the period. So, therefore, it's a floating rate, okay. But also bear in mind, please, that theoretically it's possible that over the period of 3 years, all the 6-month settings will be the same. You can't rule out that possibility because very unusual, but it could theoretically happen. That will happen, which means case, although theoretically it could change. So the question is, how many times the rate is being set or changed or determined, okay? Which means that there is a process to change or determine the rate. There's a process to redetermine the rate, but the redetermined rate could theoretically be the same as the previous rate. That is a possibility you have to account for, which means there's no movement in the market. But the point here is that there is a process to change or redetermine that rate. That's what makes it a floating rate. If the answer is greater than once, then it's a floating rate. Okay? That's basically a mechanical. So it's a good question because it forces us to come up with a mechanical definition of a floating rate instead of a subjective definition. This can be applied by a computer, this definition. So all definitions have to be ideally like this, otherwise they are not very satisfactory. Okay, so we looked at the contract. Now you understand how the contract terms will work under the different obligations and the different obligations of the parties. That Apple has to pay fixed percent, 3%, and Citigroup has to pay 6-month LIBOR. And as we said, the determination of the payments, that in this case, this is normal LIBOR, it's not LIBOR in arrears, okay, where it's not LIBOR in arrears, so which is a structured product kind of structure, which is the where you see that in structured products. So it's normal LIBOR, so it is set in normal LIBOR is set in advance and paid in arrears. So what happens? Another feature is, of course, that. So we now know that whatever was the 6-month LIBOR setting 6 months ago, that's what Citigroup will have to pay after 6 months, and Apple will have to pay 3%. Now these are not exchanged on a gross basis, so there is a net settlement. Okay. Okay, there is a net settlement. So we can actually write this here, that write it here. Net and not gross. Okay, so there's on every settlement date, there's a net settlement. On every settlement date. Okay, so the number of settlement dates will be equal to the number of times the rate is being set or changed or determined. This also, we can make a connection between this and that. Okay, every settlement date, and here do we have we have a star there. We can put a double star here and a double star here, and we can put a star here and say that right? Same thing. Number of settlement dates is equaling the number of times the percentage rate is being set, changed, or determined over the tenor of the deal. Okay. This has to be reworded a little bit because the fixed rate is only being and how would you determine the floating rate? So it's a two-step determination. How do you know the number of settlement dates? It's equal to the number of times the floating rate is being set, changed, or determined over the tenor of the deal. And how do you know which is the floating rate? That you'd ask whether this rate is being set or changed or determined over the tenor of deal. Is it more than once? One of them will be, at least one of them will be more than once. Okay. So, and then that will be the floating rate. That will be the floating rate. And some of them, there may be some floating to floating swaps as well, which we call basis swaps. We'll come to that. But so therefore, it's not necessary that both the rates have to be fixed. But as I said, at least one of the rates will be determined more than once over the tenor of the deal, set, changed, or determined. And that will be the floating rate. And therefore, number of settlement days is the number of times the floating rate is being set, changed, or determined. Let's check this here. Here, Citigroup, 6-month LIBOR, 3-year transaction, which means there are going to be 6 rate settings. The first one is on the transaction date itself. You get to know the first period's payment. Citigroup gets to know the 6-month LIBOR on this date itself. But there are that's also a that's also a fixing. Okay, these are called fixings. Okay, let me see where I can put in the fixing. It's called a fixing, like a LIBOR fixing, etc. Let me write this. So that you know how the terms are used. Okay, we're learning a little bit about swaps. It's also useful because these are some important products. So one of the things you have to know as a finance student is you have to know all these products. This is the part where you have to. This is how I've designed the curriculum. That the curriculum is designed in such a way that you have a good understanding of all the major asset classes. Instead of just covering equities and debt, you have to have a good understanding of all the asset classes and how they're all connected by general principles. And also you have to have a good understanding of all the product structures. These are the basic knowledge elements for a finance specialist student. Okay, So understanding the product structure. So what we're trying to do here is understanding the product structures. Right. So here we call this a LIBOR fixing. All right. So what are we talking about? Number of where will we actually? Contractors and different obligations. Net, not gross settlement of contractual obligations on every settlement date. And number of settlement dates is, we have structured products, LIBOR and arrears. All right, so we have explained what LIBOR and arrears is. Okay, now we have net settlement. So as we said, what we are looking at the contract terms and how the obligations are going to be discharged. And we make a statement that this is a net settlement, not gross settlement of contractual obligations. What does that mean? Let's take the first example, 3% for Citigroup, all right? And so if we take a transaction, we'll just do it here so it's easy to understand. So Citibank has to pay 3%. Maybe we should just do it here to be disciplined, okay? So first transaction, this is 2.9, okay? So Citi has to pay, okay, so Citi has to pay 3%. And let's assume that, no, Citi doesn't have to pay 3%, it's Apple has to pay 3%. So we'll come to that. Apple has to pay 3%, and Citibank has to pay the 6-month LIBOR, which was fixed. So let's say the 6-month LIBOR was fixed as 75 basis points. Okay, let's assume it's just 75 basis points. No, not 7.5 actually. 0.0075. Yeah, 75 basis points. Okay, so basis point is 100th of a percentage point. 75 basis points is 0.75%. So this is a 6-month LIBOR fixing on. We don't know this. They haven't told us on the in this case. What is this first? Oh, they've given the example. Okay. Yeah, 2.2%. Okay. So there, I don't need to do the calculation, but it's already there here. Okay. So Citi has to pay this. So the point here is that this is not going to be a gross settlement. This you have to understand. The settlement is not gross. The settlement is net. So in this case, since the LIBOR fixing is 2.2 and Citibank's obligation is to pay 2.2, and Apple's obligation is a fixed rate obligation of 3. So Apple owes money to Citigroup net. So what would happen is Apple would pay the difference, 3% minus that 2.2, which has been fixed. Okay, so 3% minus 2.2%. That is the amount, which is 0.8%, which is what Apple will pay to Citigroup. So there'll be a net payment from Apple to Citigroup. We determine who owes money to who for this particular settlement date, and that person would pay that money. And this is what we mean by net settlement. Gross settlement would be, there would be 2 payments. Apple would pay 3% gross, full 3%, and Citigroup would pay 2.2% full. And as you know, interest rates, they do not make sense when you're talking about a actual payment obligation. They do not make sense unless you have some kind of a principal attached to it. Otherwise, this 2% of what? Okay, so that's why you need the notional principal, because the interest rate payments, they have to be applied to some principal amount because these are percentage figures. So that's where the notional principal comes in. So in the case of gross settlement, Citi would have paid 3% times 100 million, and not Citi, sorry, Apple. And Citi would have paid 2.2% times 100 million. But that's not how it is done actually. It is net settlement. Okay, so we determine who owes more money. In this case, Apple. Apple has to pay the net amount, the difference to Citibank. Okay. So that's another element of the swap structure. So we are trying to slowly understand the swap structure and make sure we understand everything properly, okay? So that your understanding is properly. So what else do we have to note? This is pretty much it actually, okay? And then of course there are the contract governing law kind of thing, okay? Which is, so this basically covers all of it. There is obviously that you have to also mention the under contract terms. You also notice that the currency is different obligations. Let's talk about currency. Which currency? 2% in which currency? I can pay you. Obviously, here it's clear. It's dollars, US dollars. Okay. But this doesn't have to be US dollars. It could be Japanese yen, it could be Swiss francs, it could be anything you want. Okay. In fact, if you read this story about the first interest rate swap, that was between IBM and the World Bank. I think there was Swiss franc involved in that. So that was actually a currency swap, I think. If we go back to it, you can read the example. So you have to determine the currency. And also another thing I'll mention here, currency, since you've done a law course, currency, and so when you do letters of credit, some of you will go and work for banks. There's things called letters of credit. There's a certain kind of documentation that is used, legal, standard legal documentation terms. In this case, it is ISDA. ISDA used to stand for International Swap Dealers Association. Now they just call themselves ISDA. Okay, they used to call, I think they call, in the middle, they call themselves swaps and derivatives. And then I think now they just call themselves ISDA, or maybe it is swaps and derivatives. But earlier it was swap dealers. Now it is swaps and derivatives. ISDA master agreement. You'll see this mentioned in the book. When you read the book, please read the, so what I'm doing here with you is giving you a broad structure in which to understand this transaction. So you follow my broad structure, but then using my broad structure, you read the chapter in the book. And you also read this book, you read my book also and see all the different type of structures. At least try to understand the basic structures, all right? Here I've talked about, so the swaps are covered here. These are only interest rates and currency swaps. And then we have talked about, let me see what I've covered in. Yeah, so I've covered currency swaps here itself. Okay, under interest rate risk management. Okay, so you can see the structures here. These are all slightly advanced structures as we go down. Amortizing, accreting, callable, puttable swaps. These are all advanced kind of swap structures. Not so important, but at least cover the basic types of swaps up to this point. Okay, up to the forward start delay. All right, so I think we can, we'll have to close it here for today. So the ISDA Master Agreement is another element of this. I'll just cover this later on. So you can read up on all this. Please do some reading so that you can cover more material. Please read the chapter 7 and also read this part from my book so that you can get a good understanding of the product and increase, we can increase our coverage, okay? Use my framework that I've given you here. And these are all part of the contract obligations, standard legal documentation terms, the ISDA Master Agreement. Okay, so that is the legal documentation under which you're doing most of these transactions. All right, so this pretty much covers the basic structure of a swap. And then once we have understood this basic swap structure, we can now quickly cover the rest of the material, which we'll cover in the next session. Okay, so the class is dismissed. You can leave. And if anybody has a conceptual question, they can ask me. Your project starting is still not, I've not heard from the broker, so we'll have to just hold on. Just wait for I'll send you an email as soon as I get the news from the broker and from Ketan and Vipul. So Ketan and Vipul should inform me as soon as they are able to sign on to their new accounts. Okay. All right. So class is dismissed. You can leave. And anybody has a conceptual question? Nothing? Okay. So anybody has an administrative question? Okay, nothing. So we'll end the session here. Okay. All right. So we have a session with Kritika, and we have a capstone session. So she can remind me in case something happens and I forget. Okay. So we'll end